Right now, while you're watching this explainer, oil is trading near $84 a barrel. The Nasdaq just clumpsed more than 10% below its all-time high, and the bond market is sending warning signals most investors are completely ignoring. This isn't a distant hypothetical risk. It's happening this week. A conflict thousands of miles away in the Middle East is quietly working its way into your 401k, your grocery bill, and the interest rate on your next loan. Today we're covering the geopolitical timeline, the inflation chain reaction, tech and AI vulnerability, energy stocks and consumers, historical market perspective, and practical portfolio takeaways. Quick note before we dive in, this situation is moving fast, changing almost week to week, so everything in this explainer reflects data as of late July 2026. Let's dive in. Section 1. The geopolitical timeline. We need to start here, because this story has moved through several distinct phases this year, and understanding that pattern is exactly what will help you make sense of whatever happens next. Back in March, escalating conflict in the Middle East led to a full closure of the Strait of Hormuz, the narrow waterway that roughly a fifth of the entire world's oil supply passes through every single day. Brent crude spiked to nearly $105 a barrel, and the market's fear gauge, the VIX, spiked almost 20% in a matter of days. That crisis eventually cooled, and oil drifted back down as tensions eased. Then, in mid-July, the conflict reignited. The U.S. reinstated what was described as a blockade on Iranian shipping through the strait. Oil jumped again, and the S&P 500 fell nearly 1% in a single session, while the Nasdaq dropped over 1.5%. By late July, U.S. forces had carried out multiple additional rounds of strikes against Iranian military targets. Oil surged another 6.5% in a single day after reports of an attempted attack on American forces, and the Nasdaq closed more than 10% below its all-time high, technically landing in correction territory. Section 2. The inflation chain reaction. So why does a regional conflict on the other side of the world move markets here at home this dramatically? This is exactly where things get interesting, because the connection isn't really about oil itself, it's about what oil represents to the entire economy. Here's the chain reaction most people don't fully connect. When oil prices spike, the cost of transportation, manufacturing, and nearly every physical good in the economy rises alongside it, because energy is an input cost baked into almost everything we buy. That pushes inflation higher right at a moment when the Federal Reserve has been trying to bring inflation back down. And when inflation runs hot, the Fed becomes far less likely to cut interest rates, and in a worst-case scenario, could even be forced to consider raising them again. This is exactly the dynamic playing out right now. At its most recent meeting in late July, the Federal Reserve voted to hold its benchmark rate steady, but Fed Chair Kevin Warsh made a point of directly acknowledging that oil prices were rising again due to the renewed conflict and pledged the central bank would act if inflation pressures continue building. Meanwhile, bond markets are already reacting. The 10-year Treasury yield jumped to above 4.67%, and the 30-year Treasury yield climbed above 5.2%, hitting some of its highest levels of the year. When long-term borrowing costs rise like that, it makes mortgages more expensive, it makes it costlier for companies to borrow and expand, and it makes future company earnings worth less in today's dollars, which is exactly the kind of pressure that weighs on stock valuations broadly, not just energy stocks. Section 3. Tech and AI vulnerability. Now let's talk about who actually gets hurt the most when this kind of scenario plays out, because it's genuinely not evenly distributed across the market. Here's what most investors completely miss about this specific type of sell-off. It hits growth and technology stocks, especially the most richly valued AI names, disproportionately hard. We've seen this pattern repeat multiple times this year. During the most recent escalation in late July, South Korea's stock market, heavily weighted towards semiconductor and technology names, triggered a circuit breaker not once, but twice in consecutive trading sessions, with the index plunging around 8% and trading being halted entirely for 20 minutes. Here in the US, the technology-heavy Nasdaq has consistently fallen harder than the broader S&P 500 or the more defensively positioned Dow Jones Industrial Average during each wave of this conflict. This makes sense once you understand the mechanism. Growth stocks, and especially AI stocks trading at extremely high valuations, are valued heavily based on profits expected many years into the future. When interest rates and inflation expectations rise, the math used to value those future profits becomes less favorable today, which is exactly why these are usually the first stocks to fall when oil-driven inflation fears spike. Section 4. Energy stocks and consumers. On the flip side, energy stocks have actually benefited during parts of this cycle, since companies that produce oil and gas directly earn more revenue when prices rise. But even that relationship isn't as simple as it sounds, because as oil prices swing wildly, Energy stocks can just as easily reverse those gains quickly if tensions ease and prices fall back down, which is exactly what happened in late July when reports suggested Iran might suspend attacks, sending oil prices down over 4% in a single session, and energy stocks like Chevron, ExxonMobil, and ConocoPhillips all falling right alongside that pullback. Let's talk about consumer sentiment too, because this matters more than headline stock prices for understanding the bigger picture. The Conference Board's Consumer Confidence Index, a widely watched survey of how everyday Americans feel about the economy, ticked down to 90.8 in late July, below what economists expected, with the survey period specifically overlapping with this exact stretch of elevated Middle East tensions and rising gas prices. When consumers start feeling less confident, they tend to pull back on spending, and consumer spending makes up the largest single piece of the entire U.S. economy, which is exactly why this kind of geopolitical and energy shock can ripple far beyond just oil-focused stocks. Section 5. Historical market perspective. Now, before this starts to sound like the sky is falling, let's talk honestly about the other side of this story, because there's real nuance here that matters enormously for how you should actually respond to all of this. This exact kind of oil-driven, geopolitically triggered market volatility has happened many times before, and history offers some genuinely useful perspective. As one recent analysis put it directly, given how rapidly the administration's statements and policies have shifted throughout this conflict, it's extremely difficult to predict exactly where this goes next. But short-term market movements tied to headlines like these generally shouldn't be the deciding factor for investors with a genuinely long-term time horizon. We've already seen this pattern play out multiple times just this year alone. Tensions spike, oil jumps, stocks fall, then diplomatic efforts or a pause in hostilities bring some of that back down, only for the cycle to repeat again days or weeks later. That volatility is genuinely uncomfortable to sit through, but it's also historically been the kind of environment where panic selling has hurt long-term investors far more than simply riding it out. At the same time, it would be irresponsible to pretend there's no real risk here at all. One senior economist recently pointed out that the most important uncertainty facing markets right now isn't really about what the Federal Reserve says in its next statement. It's the combination of ongoing geopolitical risk layered directly on top of the enormous, already stretched valuations tied to the AI boom we've covered extensively on this channel. When you combine an already expensive stock market with a genuine, live geopolitical shock capable of pushing inflation higher, you get exactly the kind of environment where a normal, healthy pullback can turn into something sharper and more painful if sentiment shifts quickly. Strategists at Barclays have specifically warned that investors currently appear too relaxed about inflation risk given everything happening in the Middle East, noting that options markets and investor positioning don't yet fully reflect how serious this risk actually is. Section 6, Practical Portfolio Takeaways. So what does this actually mean for how you should think about your own portfolio? Let's break this down into practical takeaways, because that's ultimately what matters here. First, assess your concentration risk. High-flying AI and tech stocks are highly sensitive to rising interest rates and will likely feel the most turbulence. Second, diversify. Blending defensive sectors and energy companies can help smooth out sharp swings better than a concentrated growth portfolio. Third, monitor the bond market. Climbing long-term treasury yields are the clearest early warning signs of persistent inflation. Finally, resist panic. Investors who maintain a sensible strategy historically fare much better than those who try to time the market based on daily headlines. So, where does that leave us for a genuine, honest bottom line? Rising oil prices tied to this Middle East conflict represent a real, legitimate risk to the broader stock market, primarily through the inflation and interest rate channel we've walked through in detail. And the most expensive, most richly valued corners of the market, particularly AI and growth stocks, appear to be feeling that pressure first and hardest. But this is also a genuinely fluid, fast-moving situation that has already reversed course multiple times this year alone. And history suggests that investors who react with discipline rather than panic tend to come out ahead of those who make dramatic moves based on any single week's headlines. Looking ahead, the key things to watch are whether this conflict meaningfully escalates further or moves toward a genuine, lasting de-escalation, whether oil prices stabilize or continue their volatile swings, and whether the Federal Reserve's next moves lean toward the rate cuts markets have been hoping for or get pushed further off the table by persistent energy-driven inflation. All three of those questions remain genuinely open right now, and that uncertainty itself is exactly why volatility is likely to stick around for a while yet. So let's bring this all together. Oil prices and Middle East tensions have become one of the most important and most underappreciated threats to the stock market right now, working through inflation, interest rates, and investor sentiment all at once, hitting the most expensive parts of this market hardest. But this is also a story that's already proven itself capable of reversing quickly, and long-term investors have historically been better served by understanding these risks clearly rather than reacting to every single headline. Remember, great investing isn't about chasing hype. It's about making informed decisions. This explainer is for educational purposes only and is not financial advice. Investing involves risk, including the potential loss of principal, and geopolitical and economic conditions can change rapidly. Always do your own research or speak with a licensed financial advisor before making any investment decisions. If this breakdown helped you understand what's really moving the market right now, hit subscribe so you don't miss the next one. Like this explainer if timely, macro-focused analysis like this is useful to you, and comment below what you think happens next with oil and this conflict. Thanks for watching, and we'll see you in the next one.